For decades, digital money still meant bank money. Your salary landed in a bank account, your card pulled from a bank account. Even when money moved instantly on a screen, somewhere underneath, banks were keeping the ledger. Now the dollar is learning a new trick. It can move from one digital wallet to another without a bank account sitting in the middle of that transfer. Not Bitcoin, not a new currency, something designed to behave like the dollar itself, a stablecoin. And the strange part is that this may be less about crypto than about who gets to own the rails beneath money. A stablecoin is basically a digital token designed to stay worth $1. The simplest version works like this. You give an issuer one real dollar. The issuer creates one digital dollar token. That token can then move across a blockchain. When someone redeems it, the issuer is supposed to return a dollar and destroy the token. That sounds almost boring. Good. Money is supposed to be boring. But look at what changed. With a bank deposit, your dollar is an entry on a bank's balance sheet. With a fiat-backed stablecoin, your token is a claim tied to assets held by an issuer. The unit still says dollar. The plumbing underneath is different, and plumbing matters most when the old pipes are awkward. Take a cross-border payment. Traditional international transfers can involve your bank, a correspondent bank, another correspondent bank, foreign exchange conversion, local settlement windows, compliance checks, and finally the recipient's bank. Each institution is doing something reasonable. Stack enough reasonable institutions together, and suddenly Tuesday's money arrives on Friday. Stablecoins offer a different route. A sender can move dollar-linked tokens to a recipient's wallet over a blockchain, potentially around the clock. In places where banking access is limited or international transfers are expensive, that can be genuinely useful. The IMF has pointed to this in countries such as Nigeria, where stablecoins are already being used for remittances and cross-border payments. But this is where the hype needs a seatbelt. The headline numbers can make stablecoins look as large as the global payment system. The BIS estimated about $28 trillion of stablecoin transaction volume in 2025, but a big share reflects trading, transfers between related wallets, and automated activity. Depending on how aggressively you filter the data, estimates of economically meaningful payment volume become dramatically smaller. So no, people are not buying $28 trillion of sandwiches with digital dollars. The interesting signal comes from somewhere else, the companies that already own payment rails. In March 2026, an IMF working paper studied how listed payment companies reacted to U.S. legislation supporting stablecoin payments. Its estimate, the legislation reduced their combined market value by about 18%, roughly $300 billion. The effect was larger for companies more exposed to cross-border payments. That does not prove stablecoins will replace Visa, MasterCard, banks, or anyone else. Stock markets are expectations machines, not time machines, but investors appeared to price in a new competitor, and the incumbents noticed. Visa has expanded stablecoin settlement across multiple blockchains and said its pilot reached a $7 billion annualized settlement run rate in April 2026. MasterCard has expanded stablecoin settlement too, and in August completed its acquisition of stablecoin infrastructure company BVNK. The old rails are not waiting to be disrupted. They are installing the new rails themselves. If you like stories where boring infrastructure turns out to be the business model, subscribe. Because now this becomes an interest income story. Suppose you hand a stablecoin company $100. You receive 100 digital tokens. The company now has your $100 in reserve. Under the new U.S. framework, permitted payment stablecoins must be backed one-for-one with eligible liquid assets such as dollars and short-term treasuries. Those treasury bills can earn interest, but the token in your wallet usually does not automatically pass that interest through to you. That gap is the business. Circle, the company behind USDC, told investors that reserve income accounted for about 95% of its revenue in the first half of 2026. In other words, a company can issue something that feels like digital cash, hold safe interest-bearing assets behind it, and build a business around the yield on the reserves. The customer gets a dollar that travels differently. The issuer gets the interest. This is why stablecoins are not simply money without banks. Their reserves can include bank deposits, treasury securities, money market instruments, custodians, asset managers, and settlement partners. Circle itself says deep connectivity to the banking system is critical to maintaining USDC's stability and redemption. The bank did not vanish, it moved backstage, and that creates a second-order problem. If households move money from ordinary bank deposits into stablecoins, banks can lose a cheap and stable source of funding. The BIS models several versions of this shift and warns that, depending on where stablecoin reserves end up, bank liquidity can weaken and lending conditions can change. Again, this is not a prediction that your neighborhood bank disappears next Thursday. It is a reminder that deposits are not just numbers sitting quietly in an app. They help fund the banking machine. Move enough of them, and somebody has to replace that funding. Then there is the word stable. A dollar-backed stablecoin can be designed conservatively with liquid reserves and strong redemption rights. But stablecoin is a category, not a safety rating. Different coins have different assets, legal structures, technologies, and counterparties. If users suddenly rush to redeem, an issuer may need to sell reserve assets quickly. The BIS warns that large redemptions could transmit stress into money markets. Regulators focus heavily on reserve quality and redemption precisely because a promise of $1 is only useful if people believe they can actually get the dollar. And there is another trade-off hiding inside the word permissionless. A blockchain can let value move without asking a bank to update its private ledger. That does not necessarily mean nobody can stop the money. The U.S. Genius Act requires permitted issuers to comply with anti-money laundering and sanctions rules, and the framework includes the technical ability to seize, freeze, or burn payment stablecoins when legally required. So we may be moving from bank-controlled accounts toward tokenized dollars, while still retaining very real control points. Different rails, not necessarily no gatekeepers. And outside the United States, the stakes get bigger. Dollar-linked stablecoins can give people easier access to dollars in countries where the local currency is less trusted. For an individual, that can be protection. At national scale, it can also mean more dollarization, harder capital controls, and less room for local monetary policy. That is why central banks sound simultaneously interested and nervous. The technology can make payments faster. The economics can rearrange deposits, treasury demand, payment fees, and monetary control. The dollar is not escaping the financial system. It is escaping one particular container, the bank account. And even that sentence needs an asterisk, because the new container is still connected to banks, governments, asset managers, blockchains, and issuers. What is changing is the center of gravity. For most of modern digital finance, the account was the product and the payment network connected accounts. Stablecoins flip that around. The token can become the thing you hold, and the networks compete to move it. That may be why the most revealing response is not coming from crypto enthusiasts. It is coming from Visa, MasterCard, banks, and regulators quietly rebuilding themselves around a future where the next dollar may arrive in a wallet first and a bank account second. If this changed how you think about the dollar in your phone, like, share, and subscribe to Unhinged Species. The new dollar may not need a bank account for every move, but it still needs somebody you trust to make $1 mean $1.